Well, I guess we'll start. We're speaking about cryptocurrency tax or taxing cryptocurrency. My name's Jim Calvin. I'm a tax partner from Deloitte. I've been, I guess, with Deloitte my whole career almost. A partner in 1995, focused on asset management, and have done quite a bit of work on trading issues, primarily on the buy side with crypto.
I'm Kelsey LeMaster. I'm a tax partner at the law firm Goodwin Procter. We have about 1,000 lawyers across 10 offices in the US, Europe, and Hong Kong. I do a lot of work with traditional investment funds, from venture capital to private equity to real estate. Over the last couple of years, I've gotten involved with funds investing in cryptocurrency, and most recently in the last 6 to 9 months, working with companies doing utility token ICOs, and we have about 40 of those in our office right now.
Great. So we've got quite a few topics. I think we're going to start out with more on the trading side and the buy side, the tax issues that come up there. But of course, we can talk about issuer issues if that's of interest as we go through it. And so I guess, Kelsey, maybe to start off with, what's the existing guidance? What does it say?
Yeah. So this is really interesting. Congress actually just this morning mentioned a proposal to create a moratorium on taxing cryptocurrencies for the next 5 years. So that's great news. Just kidding. I had to wake you guys up somehow.
I didn't know about it either. That's a good one.
You're blown away, right?
Good one, yeah.
Absolutely not. But the law in this area, at least around the basics, dealing with the main sort of types of cryptocurrency that are out there, putting aside utility tokens, is actually pretty clear, at least around kind of the basic parameters. And this is primarily because the IRS issued a notice, which is a piece of guidance back in 2014, that was focused primarily on Bitcoin, but it broadly applies to what they call, I think, convertible virtual currencies, which are any type of virtual currency that either has equivalent value in real currency, you can look it up and see how much it's worth in dollars, or it can be used as real currency. So if you meet those basic criteria, then you're taxed under this 2014 notice. And what it says is that those types of cryptocurrencies are going to be taxed under the general US tax principles that apply to property. So sort of deriving from that, some basics are if you buy Bitcoin and you sell it, generally your gain or loss is going to be a capital gain or loss. You will have to pay tax on it. If you've held the Bitcoin or other crypto for 12 months or less, the gain will be short-term capital loss or gain. If it's gain, that's taxable at higher ordinary income rates. If you hold the crypto for more than 12 months and you sell it, then you'll have a long-term capital gain or loss. Now, if you're viewed as some sort of a dealer in cryptocurrencies, which is probably pretty hard to do, but if you were a dealer in crypto, then all your gains and losses could be viewed as ordinary income. It also says that if you're mining cryptocurrencies, generally your income from mining will be taxable as and when you receive the coins that are minted from the mining process. It says that if you pay for something in a transaction with Bitcoin or other cryptocurrency and the value is more than $600, then you potentially have to report that on a 1099. So it basically applies these traditional property tax concepts to cryptocurrencies, and it's one thing that it does make clear is that you are not taxed under the foreign currency rules, which are a little bit different. Those do not apply to virtual currencies. So another way that you might look at cryptocurrencies would be to consider whether or not they're commodities. I don't know if you want to talk about what that might mean.
Sure. And just one comment on the notice is that with tax reform, I'm sure you all are aware of it, other than the repeal of the taxation of cryptocurrency. But the tax reform is pretty active right now on Capitol Hill. And we've been actively engaging to the extent possible with the IRS, trying to get guidance or private rulings, especially concerning bigger transactions, things like kind treatment. But it's really hard right now to get anything from them, get any attention on this. The technology's hard from their perspective. They got to spend a lot of time learning it. So I wouldn't expect that we're going to get or see much, in the way of public guidance, like a regulation or ruling, or even private rulings for the foreseeable future. But looking at things like Bitcoin or ETH or any fork of Bitcoin, it's probably a commodity. Based on a lot of that is the CFTC. Depending on the way the CFTC has treated it, and just to harmonize, the statutory treatment, we would expect that, with pretty high level of certainty that the IRS is going to treat that stuff as commodities. And it's, once if you can pigeonhole something for tax, then the rest of the rules tend to kind of line up. If things like wash sales apply, and straddles and that kind of stuff if you're trading it. But other areas of law as well. So if you're holding the stuff in a partnership, how it's treated there. And then there are tokens. The last couple of panels talked about treating tokens, for example, as a security. And I think if you're going to treat something as a security, you might as well look at can we attach some rights to it that would make it an equity, debt, or something else that's much more certain for tax purposes, because that can be a lot more tax efficient than having to treat it as property, right? And if you treat it as property, then what do you have to do, right?
Right.
So,
and I think while it's relatively clear how the property transaction rules work for cryptocurrencies and what the commodities implications might be to the extent cryptos are viewed as commodities, when you transition over to token offerings that are issued in initial coin offerings and that are viewed as utility tokens or perhaps securities, the tax law around the tax treatment of people participating in ICOs and in the issuers of tokens in an ICO, that's a huge gray area. There are a lot of issues there. And since others have talked about ICOs a bit, I'll talk a little bit about them as well. But most ICOs that I see, what you fund into the ICO issuer is not dollars. It's usually Ether, if it's an ERC20 token, or maybe Bitcoin or something else. Now, if you're funding into that and you're buying a utility token, you're funding in with probably appreciated positions in Bitcoin or Ether. Now, the IRS, I think, would say that that's a taxable event for you, the investor, because you've taken something that you bought at a low value and you're using it to buy something at an appreciated value, and that's a taxable exchange unless you can find an exception. And there probably isn't an exception if what you're doing is buying a utility token that's not a security. From the issuer's perspective, that transaction, it's not entirely clear, but one way to look at that is that the investor, or the purchaser, if you don't want to call them an investor, is buying future services. They're buying a token that will be usable on a platform someday if you ever build the technology. From the issuer's perspective, normally when you raise capital through a financing transaction, all that money comes in, it's tax-free. There's very clear law around that. But if you're selling services in the future, that's just revenue. So one issue that companies are dealing with in ICOs is how to manage what can in some situations be hundreds of millions of dollars of revenue just flowing into a company that hasn't spent any money yet. And if the company doesn't spend all of it within a year or maybe up to 3 years, depending on how you manage it, that's all taxable income, and a whole bunch of that value is going to get sent to the government. So it's a very different sort of model for raising capital from the issuer side and also from the investor side. If you think about, well, I'm just going to go into an ICO, that's easy. Well, there probably is a tax event there, and I'm sure it's not reported in 99% of the transactions, but I think that's what the IRS would say.
Yeah.
Go for it.
Can you address whether the BT, the Bitcoin Cash and Bitcoin Gold, ET, the Ethereum Classic forks are taxable events for the pre-fork holder? And also in terms of like-for-like transactions, is that only for other cryptocurrencies, or can other forms of property qualify as like-for-like transactions?
Well, the chain, so if you got a hard fork with a chain split, so you got cash, you got gold, the way that that's treated for tax purposes is you don't recognize the taxable income until you exercise dominion and control, which means you have to do something to indicate, ownership of it, which could be, you split the coin somehow, If it's on an exchange, they may just do it for you and credit your account, right? But normally, I think we would all evaluate the risks that are associated with the chain split, right? You'd say, okay, well, it's just the general risks of doing something like copying your private keys into a wallet and having it stolen. That's one. But then replay attacks, right? Is you want to understand and make sure that in fact there's replay protection. So there's good reasons not to immediately exercise dominion control, and you could never do it. There's some airdrops that you would never want to take advantage of, right? And just because there's an airdrop doesn't mean that you should have taxable income. So the way that it works is until you do something that evidences dominion control over that property, it's not taxable. It's like when you get a free sample in the mail, or it just, unless, and a lot of times free samples have no value anyway, but if you get something that's free, the IRS won't treat that as taxable unless you exercise dominion control, which could be, donating it to charity. There's some rulings on getting free, Super Bowl tickets or something like that. And if you give them away, you're exercising dominion control. If you use them, same thing. But not until you do that is it taxable.
I think even if you get them into one wallet and you move them to a different wallet that you also control, that's probably enough. I think it's a very hair trigger of what constitutes.
Yeah.
You're basically doing something that shows, yeah, that's mine. That is mine, I take it.
Yeah. But it's not like it's August 1st, it was taxable. That's just not the case.
And then 1031, your 1031 question. I think you had a sort of a premise in your question that you can apply the like-kind exchange rules to any tokens and any coins across the board, which I think that's questionable, but you can.
Yeah, if it's, so if it's Bitcoin, say it's Bitcoin Cash and Bitcoin, right? The tests that apply are for intangibles. It's not, there's some rulings on like gold coins, bullion, gold for silver and stuff like that, but that doesn't have any relevance. The relevant rules are, are the rights similar, or like kind, and is the property like kind? And so if you look at, Bitcoin, Cash, say you've got your Bitcoin Cash, it's, the pre-split UTXOs, right, that are associated with the Bitcoin, exact same rights, or nature and character of the rights are exactly the same. It doesn't matter if it's pre-split or post. They're exactly the same that you would have with Bitcoin, right? Same sort of cryptography applies in order to, demonstrate that you control that. And then the underlying property is virtually identical. I mean, there might be some differences in data structure, but if you were to compare Bitcoin to Ethereum, I think that's an Ether token. I think it's much harder.
One thing you might consider if you are planning to make a big exchange and rely on 1031, this is part of the tax reform proposal that's out there,
That's
is
right,
that 1031 under the new tax reform would be limited to real estate, thanks Donald Trump. But it would not, even if you have an argument now that you can apply it to different coins, you won't if that version of the tax reform bill gets enacted.
And that would be beginning next year. So, if you've done things, this year, whoever your accounting or law firm is that you're working with, you'd, talk to them about helping you out on it. But it could work for this year, depending on what you've exchanged. Like if you're on Bitfinex or, Poloniex or something where you're just exchanging, coins that's not converting it into fiat, there might be some things that you could do.
Is there a question there?
So, following on your point about the dominion and control aspect of this, if you own a vehicle, for example, like the Bitcoin Investment Trust, and they're selling the Bitcoin Cash that they own for the benefit of the underlying holders, and you don't have any dominion control over what they're doing, and ultimately you hope to get your pro rata share of the Bitcoin Cash US dollar distribution that they're going to be making. I assume that what you would say is that's not taxable to me until I actually receive those dollars in my brokerage. Is that correct?
Well, it's, I don't know because I advise them or, but there is an agency issue there, right? Is somebody acting on your behalf and, have they acted within the boundaries of that and therefore, it's taxable whenever they exercise dominion and control over it on your behalf.
Yeah, it's interesting. I mean, Coinbase is another example, right? They haven't even shown your Bitcoin Cash balances yet, and they won't until January. So does that mean that anybody who holds on Coinbase just doesn't have a taxable event until January, even though we know that because I own Bitcoin on Coinbase, I know that I have an account with cash in it, I just can't see it yet. I don't know.
Unsettled?
Unsettled.
Yeah, well, I mean, they're going to have to take, they're going to have to take a position on it, or you will, but, it's going to come down to, did they exercise dominion and control, for you legitimately? When did they do that? Because that'll establish the value. And so I think those would be the two questions that would need to be answered.
Yeah. We had one back there.
What about crypto to crypto when you can't find the value of the other token? And I don't know, I'm not a lawyer, but I did hear that it might be an unfair burden to the investor to try to figure out their taxes, given like how difficult it is to follow trading with all the different platforms.
Yeah, well, there are a lot of unfair burdens in the U.S. tax law. That's never stopped the government. So they probably are not going to fix that problem necessarily. It's a good question because a lot of investors there's no way people who are trading in and out of Bitcoin to Ether, using Shapeshift and going into ICOs, and people have no idea what their basis is. They have no idea when they bought which coins. There's a real question about let's say you want to comply, right? And I'm going to sell 10 Bitcoin tomorrow. And I have 100 Bitcoin. Which 10 am I selling? How do I even determine that? I guess you can figure out a reasonable way to figure out which ones you bought first, and I suppose everything's timestamped, so you probably can figure that out. But that's like the simplest example. But when you go into your transactions, right? I'm going to use Bitcoin last August 31st, and I bought 1 million whatever tokens. What's that all about? I don't know how people are going to deal with compliance, but I do believe that given how big this market is growing, that the IRS will start to audit people and dig into this. And they do have this notice from 2014, which lays some very clear ground rules. Even though they are very difficult to implement and to track, they're clear in a lot of situations, even situations where it'd be very difficult as an investor to track that stuff. So, I think that if you hold large positions and you've been moving in and out of a lot of these tokens and coins, the IRS is probably going to start really digging into this stuff.
And the best, well, I'm not disagreeing, I agree completely, but I think the best advice, or gosh, not the best advice because it's our recommendation, which is not an objective evaluation of that, but is to have in place what we call standing instructions, right? And the standing instructions, timestamp them. Right? You guys know how to use a blockchain timestamper. And the instructions would say, I am going to sell, the highest cost first. And if it's a tie, I'm going to sell the longest held first out of those. And what that'll do is, it'll default everything to, the lowest realized gain that you can have, and then a long-term gain. And then you can always reserve the right to then, prior to the trade, do something, in the alternative, which is, I want to sell this one for some reason or exchange that one for some reason. But then that gives you some protection because what you have to do really is accumulate all of your accounts, look across it for some purposes. And one of the things that I guess we should talk about it now is in one of the tax bills in the House, and it seems likely that they'll do this, is everything will be FIFO. Now, FIFO is first in, first out, but it's based on rules that apply for information reporting to determine what are the assets that are subject to that. And right now, I think it would only apply to Bitcoin if there were regulated futures contracts that have been approved for trading, right? Because nothing else has been approved for trading. So it's probably maybe just Bitcoin that would be subject to FIFO, but we'll see.
Yeah.
My case is probably similar to some of the others here, where I bought in Coinbase, I've transferred some to Jax, I've transferred some to Poloniex, I've bought and sold Ethereum, and some Dash, and some all different types of currencies.
And you don't know the price when you did the exchanges and the U.S. dollar?
I have into it globally.
Yeah, right.
U.S. dollars I put into it. it would be really hard to determine what's long-term versus short-term. But I know at the point where I cash out more than I have into it, what that amount is. Because you're going between, I transfer a lot between Bitcoin and Ethereum and back, and
Yeah.
when it's low, so when it's high, but because I've been managing it that way.
Yeah.
Do you think I'm doing the best I can for the tax year when I just say, this is how much I actually pulled out and be taxed on that as a capital gain?
Well, it's probably a capital gain, but you know, what you're really supposed to do, right, is when you make an exchange for something. Assume it's not like kind, right? So it's taxable. So you exchange Bitcoin for Ether. You need to know what the U.S. dollar value is at that point. It's what at that time, because it's as if you sold. Say you're exchanging Bitcoin for Ether. It's as if you sold Bitcoin, for something, which would determine your gain on that, and then you took the proceeds and you bought Ether, which would be your basis.
It's hard to track down
Oh, I know.
different wallets and
Yep.
all sorts of things.
Well, you're not alone if that makes you
Yeah.
feel better. So, I mean, it's just, that's the way it is. I mean, it's just,
You think your best, you do the best you can.
keep your records too. Make sure you keep all your records and do the best you can, because if you're challenged, you want to be able to, respond. You don't want to have no information, because then they'll just market to market on you and, say, prove it's something else. Yeah.
Oh, we go over here. Yeah.
I was just wondering, in your opinion, what might it take for the IRS to gather the motivation to reassess this and maybe offer some more concrete guidance? Obviously, there's a lot going on right now on other fronts, but what might be the tipping point that might get them to be really taking a look at this?
So what might be the tipping
ETFs.
point for the IRS to look at this more heavily?
Yeah, I mean, I think it'll be the effect, something like a regulated, exchange traded product, like an ETF, like spiders or something, something of that magnitude, they're going to get focused on it. The market capitalization.
Yeah, I mean,
don't know,
I think just the sheer size of the market, the IRS isn't blind to the fact that the market's $300 billion now, and a lot of people are becoming wealthy, and I think that it wouldn't surprise me if the IRS starts jumping into this anytime, personally. But,
Yeah.
For airdrops, would you say that the capital gains are calculated on when you take ownership of the coin or when the drop happens?
Well, it's probably not capital gain.
yeah.
It's either, well, it's probably ordinary income. I think it's hard to get to short-term capital gain, but it would be at the time that you claim it, accept it as your property. So if you don't know about an airdrop, or you don't claim it, or you don't want to take the risk of having to claim it for whatever reason, then it's never going to be income.
You could argue that an airdrop is a stock split.
Nope.
I mean,
But you could argue like a network effect or something like that, right? Because I mean, you see that with the chain split. It diminishes but you can't. It's really hard to prove. I mean, you could look at hashing power and things like that, but I don't think.
Yeah. I mean, the problem is that the rule that allows you to treat a stock split as tax-free, it's under a very specific section of the Internal Revenue Code. There's a 368A1E and E-recap, or sometimes the stock distribution rules. But you have to have stock in the first place. And for a lot of these, I don't think anyone would suggest that Bitcoin, Ethereum, the true cryptocurrencies are stock. I mean, they're not an interest in a company. The utility tokens that are issued by emerging ICO companies, a lot of those probably aren't stock either. Some of them are. We're working with a couple of funds that are creating what they call tokenized funds, kind of like blockchain capital. And they are forming a feeder vehicle that will issue tokens as a way to raise capital into the fund. And those tokens, I think we've concluded that it's probably more likely than not the right view to view those as stock, those tokens, because they're really the only equity interests in that entity that's feeding into the fund. We're also working with a company that's developing sort of an investment banking platform to help other companies do ICOs, and it is also going to raise money through its own ICO. But the tokens in that company are really going to operate more like shares of a company. They're going to entitle the owners to dividends and rights to share in the appreciation of the business. So for that type of token, yeah, it probably is stock, and you might be able to get to a position like that if there was an airdrop on a token like that. There probably wouldn't be, given the nature of that token. But you do, someone on one of the prior panels talked about how you have to look at the essential nature of the token. And that's true in the tax world too. It's just because something is a token or a crypto, that doesn't, tax treatment doesn't just fall out of that. You have to look at the substance of what is it that you're buying and you're owning. And in some cases, it might be a right to receive services in the future. In some cases, it might be equivalent to stock ownership. In some cases, it might be true cryptocurrency and property under the notice.
Yeah, it's, for a token, it's, for tax, it's easier if we treat it as a security and equity, because it's just, it's much more tax efficient. All these, rules fall into place. But obviously, it's, securities and commodities rules become much more difficult in that case. So.
Question in the back?
So this is related to the Bitcoin/Bitcoin Cash fork. So if I believe that Bitcoin Cash, and this is actually the case, but if I believe Bitcoin Cash was the actual Bitcoin, and what's now labeled as Bitcoin is now a derivative coin, the moment that I move my Bitcoin to another address, am I now incurring tax? Whereas if I left my Bitcoin Cash alone, there's no tax payments going to go back. Like there's ambiguity as to which asset is actually Bitcoin.
Yeah, that's very esoteric. Sort of reminds me of which is the spoon, right, in the Matrix. It's like,
I was coming from a computer science background,
yeah.
and when there's a fork, there literally is, it's ambiguous as to which one is the actual, which one deserves to have the name of the original chain.
Yep. Would you look at the, you'd look at core as the software, and then you would look at cash as the copy, and cash they activated the chain split, and therefore, Bitcoin Cash.
Later in August, Bitcoin Core issued another hard fork. That we called it Bitcoin before, we called it Bitcoin after.
Mm-hmm.
But there was a hard fork at that moment, and there's an argument, a logical argument to be made.
Yep.
That Bitcoin is still a different currency. The Bitcoin we use now is a completely different currency. It's a forked currency of what was the actual Bitcoin before that fork.
Yep.
And how is that ever going to be reconciled? Because this happens to all the cryptocurrencies constantly.
Well, it's, you're talking about the subsequent hard fork subsequent to Bitcoin Cash.
Yeah, you said
Yep.
that if we can't treat
Right.
it like a stock split, then like a company splitting into two separate companies, we can't treat it like that. We have to recognize one of them
Mm-hmm.
as being the original and the other one as being now subject to income tax the moment we do anything. So you have to differentiate between which one is which, and if there is no one telling you which one is which, you can choose which fork you want.
I guess I might have looked at it, and maybe you'll say this is not rational, but if after the fork, there are now two different coins, and one is much more valuable than the other, I guess I would have thought the one that's much more valuable, it's rational to say, well, that's the one that I've held. That's the one that has been around the longest. And then the new one, which is just starting out to build value, that is the new asset that is taxable. And I mean, that's the taxpayer favorable answer, but it also seems to me to be rational, even though it maybe defies sort of the logic.
No, it's an interesting question. I mean, it's, but, which one is, I guess which one's the free sample, right? Which one is your free sample? And,
How do you think the IRS is going to land on that?
well, I think,
They're not going to understand this for like 15
well,
years.
yeah. Well, first of all, they're not going to get to that question, so don't bring it up. But because then we'll never get an answer. But I think they would probably, you could go back and say, okay, if I held like a UTX, like the Genesis block, UTXO, right? Whatever that is. What would I have now? That's one way. I don't think that really works. I think it's better to look at the software and what was copied as constituting, the new version versus the one that continues on and is supported by core. And the one that's supported by core is, there are gonna be hard forks there, right? And maybe somebody continues on with their own chain, and you might say, okay, well, isn't that the real one? But it seems like you would look at that hard forked version that core is supporting. Where's the hash? Is the hash power following it? Maybe there's a combination of things that you need to look at. And when we looked at cash and gold, I think we looked at it from the point of view as the copy of the software in that case, as a way to rationalize ultimately the conclusion. But, I mean, it's a really good point, no doubt. Just don't bring it up. No, seriously, it's good.
Are we done with time?
Cash isn't taxable until I can sell it or get dollars. Is that correct? I mean, I can be taxable if I don't control it, if I can't.
So I think there is a view that the dominion control argument, I think that's a good view of the law. There is an alternative view, which is that as soon as it came into creation, it was taxable to you. There's a doctrine in the tax law that basically says anytime you exceed, there's an accession to wealth, then it's gross income, no matter the source. So if you catch like the 50th home run, ball in the World Series, and that's worth $1 million, as soon as you catch it, that's taxable income. That's very theoretical. Nobody pays any attention to that. But there is a view that you're taxable the moment that the airdrop occurs. I think Jim's view is like the more kind of thoughtful, what's really going on here view, and it's really the samples case law, the free samples case law makes a lot of sense here, that if people just send you stuff in the mail and you don't want it, it can't be taxable to you until you actually assert some sort of control over it. You put it in your library if it's a book, or you put it on if it's clothes. Here, if you get airdropped coins into your wallet and you do nothing, I think then the view is that that's not taxable to you. But if you do anything, really anything besides just letting them sit there, I think that could be evidence of dominion control. You move them to a wallet, you sort of transfer, some of them or all of them, something that sort of somebody could point to and say, yeah, you really did want those, they're yours, they're taxable at that point. Well, then you get into these agency questions. If somebody else did something on your behalf, like if Coinbase actually took custody of all those, the Bitcoin Cash, even though you can't see them and you don't have any access, I think there's a concern that once they took custody, that was enough of an action because they were doing that as your agent, even though you don't have control right now.
How would you know when that was?
Well, you'd know which year it occurred in, which is all that matters for tax.
Well, what about if on the main Bitcoin chain you have the private keys that are the same that correspond to the Bitcoin Cash chain, and then you move something on the Bitcoin main chain?
And let's make this the last question because we're already 20 minutes over the next.
Oh, okay.
Oh, well, let's finish.
So you've got
Well, because
private key.
the cryptography works on both chains the same. So
Yep.
if you have the private keys on the
So
main
these are
chain-
pre-split coins on both, or it's pre-split Bitcoin, right?
Yeah, and the
And
private key
UTXOs, yeah.
corresponds to both chains. So what if
Yeah.
on the main Bitcoin chain, you move money around the
That's
same
okay.
amount that you have,
And you don't move the Bitcoin Cash.
but you've used the same private key on the main Bitcoin chain to move.
I don't think until you do something to the Bitcoin Cash, you move that, or I don't think you've exercised dominion control over it.
But even though the private keys are exactly the same.
Yep.
Great, thank
Okay.
you.